P2P lending is often promoted as a safe way to earn passive income. While it can be a great tool to increase your financial wealth and mitigate the impact of inflation, P2P lending is not what many investors think it is. In today's video, I will introduce you to what many investors believe is true about P2P lending. I will also put things into perspective and correct those misbeliefs so you know exactly what to expect when lending money to others. Because the chances are that P2P lending is not what you think. I'm your host Jakub from P2P Empire, and if you are interested in becoming more educated about earning money online by investing in loans, consider subscribing and hit the notification bell to not miss out on future videos. Let's start with the first disbelief I keep seeing amongst P2P investors, which is to think that all P2P lending platforms are the same. After investing in many different platforms for several years and visiting most of them myself, I can confirm that there are not two platforms that are the same. There are significant differences in business models that various platforms are following. We can categorize them into crowdlending and crowdfunding platforms, P2P lending platforms, P2P lending marketplaces, and crypto lending or earning platforms. We can further segment platforms within those categories based on their niche or market. Every category has different risks and opportunities that you should be aware of when investing on those platforms. While all of them offer yield on your investment, the way they earn the yield is different, and so is the risk. The same is also valid regarding the regulatory environment. While the crowdlending and crowdfunding space is slowly moving under regulatory supervision, and P2P lending platforms that fund their loan book directly typically have a lending license in respected markets, the regulatory environment for crypto lenders or P2P lending marketplaces is not established. Except for Latvia, no one regulates P2P lending marketplaces that lend your money to borrowers via third-party loan originators. This type of business model is simply not supported in Europe. While the term P2P lending platform is widely used, you should not ignore the differences between various platforms. It's like comparing cars with bicycles, trains, or jets. Every type of transport will get you from point A to point B, but the way you get there is very different. All P2P lending platforms will make you money, but the way they earn the yield varies significantly, and so does the risk. Believe it or not, some investors think that the advertised return on a particular platform is set per investment. So if a platform promotes a 10% yield for investments in short-term loans, some people believe they invest €100 and get €110 back within a month. That's not really how this works. Every advertised return on a platform is the annualized rate, meaning when you invest €100, you will get €110 back in 12 months as long as you keep your money invested. The interest rate does not represent your yield after the short-term loan is repaid. When comparing platforms on P2P Empire, we also list the average annual interest rate on a particular platform, meaning you will have to invest for 1 year to receive this yield. P2P lending is not a get-rich-quick scheme. Another misconception in the P2P lending space is that you cannot lose money. Being overly confident in the promoted protection systems on particular platforms can be very dangerous. Buyback guarantees and claims that your investment is protected by up to €20,000 can easily mislead you, especially if you are just starting with P2P lending. The best example is Mintos, where investors are waiting for the recovery of 81 million from suspended lenders, who also offered a buyback guarantee. There is no 100% guarantee that you will be able to withdraw your money, not even on regulated platforms. There are also plenty of bad players that abused these types of promises and already stole millions of euros from P2P investors. If you want to learn more about those cases, you can watch one of my recent videos where I expand more on this topic. The bottom line here is that you can dismiss any marketing statements about any type of protection scheme. You must trust the platform's risk management to protect your interest and mitigate existing risks. The performance of the loan book, together with the evaluation of the collateral, are the absolute key factors to determine the risk of your investment. This is also why I visit various platforms and interview risk managers to get more insights into how they manage the existing risks that are directly correlated to my portfolio. By investing on a particular platform, you rely on the ability of the team and the risk appetite of the decision makers and their willingness to protect your investments. If those people are incompetent, you will lose your money sooner or later. Suppose you are planning to invest higher amounts. In that case, I highly recommend educating yourself about the risks you are taking and even visiting and talking to the people running those platforms to get a feeling about who is managing your money. I guarantee you will learn more about the risk on a particular platform by talking to them directly than just reviewing their website, which is unfortunately often where the due diligence of most investors ends. Moving on to another misbelief that is often supported by panic. It's not uncommon for loans to be delayed or even defaulted. Many investors seem to act as if when loans start moving into the delayed status, they are about to lose all of their money. As long as all loans have the status current, all is good. As soon as a portion of the portfolio gets delayed, investors start panicking and wasting their time on social media to discuss their assumptions about why certain loans are delayed. Of course, if that's something you believe will improve your well-being, you are free to do whatever you want. I think, however, that this is quite energy draining and, to be frank with you, also counterproductive. I see a few issues here. One is that delayed or defaulted loans don't necessarily represent losses. Although this is quite platform specific, I could understand that it's hard to evaluate the risk if you have limited knowledge about a particular lender or a particular platform. You can reach out directly to the platform and request an explanation. That's probably the best approach. Platforms must deal with delayed or defaulted loans daily, so you won't be the first client to contact them. If you don't get a plausible answer, it's a sign that the platform is not very good at supporting investors and you should perhaps look elsewhere. I also think that delayed or defaulted loans trigger investors because people are emotionally connected to their money. This is something many investors, especially at the beginning, struggle with a lot. Some years ago, I was in the same position, which was very energy draining. I learned to disconnect any emotions towards money completely, and I can tell you that it's very liberating. I highly encourage you to invest money that you don't need or that won't impact your lifestyle should you lose them. This also leads to the third issue, which is connected to the emotional state of angry investors: overexposure. If you can't sleep at night because you have delayed or defaulted loans on platforms like Estate Guru, you should seriously rethink your investment strategy and exposure to P2P and crowdlending platforms. I remember that when I talked to the CEO of Mintos a year ago, he told me off the record that investors invest too much money in P2P loans, and if I were invested in Mintos, I would understand why. No one wants to deal with suspended lenders and pending payments, which causes nothing else than just frustration. The exposure to this asset class should align with your knowledge in this field and your risk profile. If you're looking for that thrill similar to what you get when trading stocks or crypto, P2P lending is not the right fit for you. If you're looking for stable returns, you should seriously consider investing in loans and educate yourself about this asset class. Remember that there is always a limited upside to P2P loans, while the downside can be up to 100% if you don't do your due diligence and monitor your portfolio. Another interesting misconception I keep noticing is that investors have unrealistic beliefs about the infrastructure and the team behind a P2P lending platform. Many expect that an investment platform is run by 100 people in a fancy skyscraper. Well, it's not really the case. The size of the team depends on the platform's profitability and business model. Lending platforms like Estate Guru or YouHodler have a team of 50 or more employees working from various countries, so you won't even be able to meet everyone if you visit their headquarters. P2P lending marketplaces, which are basically just a middleman between you and the loan originator, don't require such a huge team. A risk manager, CEO, IT manager, and a few people who help to run the operation are usually enough. So if you expect an entire office building with employees running a small fintech platform, you should manage your expectations. Last but not least, I have to mention that many investors seem to be very naive about the information that platforms publish. Unfortunately, most platforms in the P2P lending or crypto lending space are not something investors should even consider. You should be closely monitoring the information that the platform is publishing. Most platforms don't communicate any bad news with their clients, instead they focus on pushing promotions to attract more capital. As with everything in life, nothing is just positive. And the same is valid also in P2P lending. Loans or lenders will default, that's a risk you have to accept when investing in loans. If a platform cannot transparently communicate the current status and provide information about any recovery procedures, then you should consider investing somewhere else. Remember that scammers won't tell you that they want to steal your money. And if they admit any wrongdoing, your money will be already gone. You would be surprised how much BS we get into our inbox from dubious platforms with no track record that want to be mentioned on P2P Empire. Luckily for you, our community is our biggest asset, and we make it our job to shield you from harmful platforms as best as we can. Unlike other websites in the industry, we don't accept sponsored content to ensure the authenticity of information that you can consume for free. While we leave a lot of money on the table by choosing this path, we understand that having access to accurate information is the most significant value we provide. I encourage you to always do your own research and verify any information before acting on it. Making sound financial decisions also means spending time on education and learning to take responsibility for your actions. The goal of this video is not to discourage you from investing, right the opposite. If you want to protect your buying power, you have to invest. But do it responsibly. So I hope this video helped you to debunk some misbeliefs about P2P lending. If you have some experience in investing in loans and can think of any other situations where your expectations were not met, let me know in the comments below. If you found this video helpful, do me a favor and hit the like button. Thanks for watching, and I'll catch you in the next one.